Okay, so this is Fortinet FTNT. Today's date is, well, now it's December 5th, 2013, Thursday, December 5th, but it's before market opens. It's 12 in the morning. So here we've got resistance and support levels. The stock looks like it took a nice gap down back to previous support level. The stock is in a trend channel. This is the daily chart. And so you can see I've got fib clusters at 1592, so that call it 16. And then if it really wants to pierce the bottom of the trend panel for support, trend channel, it'd be 1450. Okay, indicators are looking negative, which is obvious because it just took a huge crash, and it had been on the way up. Now on the resistance level, we have a target of 2050, call it 2042 to be precise, and 2243. Back at the previous high, we have fib clusters over here, and we also have the 50 and the 200 period moving average at the 2042 level. So I would say that the 2042 level is a very good target right here. And as far as the news and everything goes, this is on FinViz. You can see we had a 48 cent, which is a 2.8% move on Wednesday. You see the gap down. It's a decent company with, it's in this application security, internet security world. Notice what I really like is that between July, May, October, November, lots of coverage on this stock. April, all of them in the 20 range. So this stock, and you've got a lot of smart people here at UBS, Oppenheimer, Gabelli, Barclays. They all have targets in the 20s, mid 20s. So we're trading at 1750. So I kind of like this, and also the news over here. You can see here it says that Fortinet sell-off is overdone. Supposedly UBS says so, and the news that this resignation for personal reasons supposedly is only for personal reasons. It's not due to any shenanigans, supposedly. So let's take a look at option view real quick. I want to show you how I use this. Right now, the volatility, first thing I look at, you can see that this thing has earnings spikes like an EKG. Earnings had just come out back the end of October. So we can expect an increase in volatility. We're at the 31st percentile, meaning 70% of the time volatility is higher than this. So it's not at a low implied volatility, but it's definitely not high. So that means we could be safe in buying options, not necessarily selling option strategies. So what I like to do is use Trade Finder. I plug in my asset. I've got Fortinet. I'm going to put in a $21 price target, and I want to put a January 17th date. That's 1 day short of the January expiration. And I'm going to say let's have a 7% increase in implied volatility. And for strategies, let's just for now look at the long option. Option view allows me to look at all option strategies it'll scan for. And just to keep numbers even, we'll go ahead and say let's use a $10,000 capital provided. And my filter, I'm just going to keep it simple. I want to make sure that we've got a bid. Do I care about open interest? With this stock, I don't care about open interest right now. So I'm just going to say option view, give me the best long option by itself. And here I can sort by best case return. You see BCR, that's a best case return. With $10,000, it'll return $22,000 by that date. that I have the target by January 17th with 7% increase in vol. And so if I click on that and hit the Analyze button, this is the risk-reward graph. And I can squeeze this in, squeeze it out. What about I've already gone ahead and done some analysis on this before with some straddles and strangles. You can see I've analyzed a lot of different trades. It looks to me as if the best trade for risk reward is this blue line. When I hit the D button down here, it gives me the details. It says for $10,000 of capital, I can buy 110 of the January 18 calls at 90 cents. Okay. If I want to risk a little bit less and still get a decent return, I could go ahead and get 82 of the June 21 calls. What I like about this is that even though my target is for January 17th, I'm going to have these options out till June for 30 cents. Now it's the 21 call. But notice, watch what happens if by January 17th we don't have a change. Notice right now we'll get a $13,000 return if we hit 21. If we have no change, it'll drop down to $8,000 in profit, still not bad. What happens if we get there in 14 days? Well, we'll have a $9,500 gain. And what happens if we had a 3% increase in vol? That would pop us out to $13,000 of profit. That's with the 82 June 2014, 21 calls. 82 of the 21 calls. That's with $10,000. Would give us a $13,000 return. Now, if we were to use this other trade here, this is the January 18 calls. If we were to do that within 14 days and with a 7% increase in volatility, we'd have a $25,000 gain with $10,000. With no change in volatility, only only dropped $1,000. So if you really believe that we could hit 21 within 14 days, this would be the better one. Obviously, your expiration is something you have to watch out for, but we still have a couple of months with January, so you would have time to roll this out if it didn't happen soon. What happens if we only went up to 1850? Well, for $10,000, you'd only pull in $2,500. Okay, so and what if we had a 3% increase? Not much. So you're really looking to hit that 21 target. Okay, that's where your gamma really fits in that curve. If we hit 20 by the December 19th, we'd get $15,000. With the January 18 calls for 90 cents. If you want to see what that looks like with the June 21 calls, 14 days from now, if we only hit 20, you'd make $10,000. With a 0 increase in volatility, we'd get $5,700. There are some other strategies that could be employed, but just to keep it simple, I'd say that those two are your best bet. Either the June 21 calls or the January 18 calls. January 18 calls obviously have the better curve. Okay, hope that helps, and let me know what you think. Okay, bye.